Hi everyone, welcome back to the Crypto Buzz UK channel. I hope you're well wherever you are. I'm sorry I've not uploaded a video for 2 weeks. I've been in Florida actually with the family. What a wonderful place, really nice people. I really enjoyed my time there. So if you're from there, props to you guys. I love the place. But anyway, we're back in action now. We've just had the monthly candle close of May. That obviously opens up numerous areas for discussion. I'll cover the short-term piece as well as the macro, but the main question I'm looking to address today is whether it is likely that this is the bear market bottom. In that, obviously the last few days we've seen some bullish price action. We've moved up from $25,500 all the way to $32,000, a $7,000 move in short period of time. Or secondly, is it likely that this is a temporary relief rally with more downside to come? All right, so should we go all in now on the basis that the trend is fully reversed, or actually should we just stay patient, see what happens over the next few weeks and months on the basis that actually this is just a temporary relief rally with more downside to come? So if you do find this content interesting or valuable, please like and subscribe. Obviously, as always, I always say it is hugely appreciated. I always kick off with sentiment. We're still where we are, extreme fear. Even though the markets, equities, indices have moved up significantly over the last week and a half, sentiment is a lagging indicator, if you like, on the read of the market. So no surprise, we're still in the zone that we have been in for the last month or so. Crypto is very much the same. We're out of that bottom range, if you like, of 8 and 10. We've just gone into 16, which isn't really noteworthy. It's worth keeping an eye on, but either way, it's the same story there. But I think I'll try and kick off firstly then with, I suppose, the bullish case. What suggests this rally is actually the official bottom? It's a difficult question. It's effectively a coin flip. So I'll run through 5 or 6 reasons on each side. So the bull case and actually the sort of bear market rally case on the other hand. So I'll first kick off with the log growth curve. Most, if not everyone, is familiar with this. Basically, in short, it's an excellent time to buy, generally speaking, whenever we are below the green line. Okay, so obviously there's, it's mapped out logarithmically with fib lines, but generally speaking, that's the perfect time to buy. We touched this line in 2018. That was bear market bottom, and obviously the Rona dump in 2020 was an excellent time to buy. And guess what? Lo and behold, we're right underneath it. Is this a time to be selling? Well, obviously not, in my view. However, should this be a positive for the bulls? Absolutely. Well, yeah, you got to take it at face value. We are below the logarithmic growth curve, which is historically speaking an excellent time to buy. The second reason for the bulls, if you like, in terms of is this bear market bottom, in that it is the Coinbase volume. I'll link to this video, my previous analysis on Coinbase volume. But either way, this chart here highlights the bottoms. So whenever we have these large volume signatures, as you can see at the bottom here where my cursor is, here was the 2018 bottom. It was a significant deviation above whatever the mean was at the time. Here, this was a market peak, which resulted in a huge sell-off. By the way, March 2020 dump, huge volume signature here. And also we had a huge volume signature here, which was the sort of May, it's this time last year, May 21, June 21 sell-off, which marked the bottom before it turned. So here you can see we moved up. Here you can see we moved up on this large volume signature. Here you can see we moved up on this large volume signature, and you'd expect in theory that from here, given the large volume signature, we should really move up. I'm not saying we will, but that's just one clear argument for the bulls, that the bottom is officially in. I'll move on swiftly to price action. Really briefly, I'll take it down to the daily chart. For this, I'll turn the log growth curves off. What you can see here, if we zoom it right in, so this precedes a sell-off in 9th of May. If I was to just draw a brief trend line here, you can see that we formed somewhat of an upward channel, assuming that's a slight deviation. Okay, so we formed our low and then aggressively moved up with a large engulfing candle. If we go back down to the weekly, and I'll take you back to June, sorry, not June, December 18, going into the rally towards June of 19. You can see something similar. People might argue, although this is on the weekly time frame, so obviously a lot more time had passed. So you can see here we had a not too dissimilar structure. What people might be willing to compare at this stage. It's a lot of disbelief. There's a massive squeeze of shorts here, which resulted in huge bullish price action. Effectively, we have the similar sort of recipe, albeit over a short period of time. There's a lot of shorts that have been liquidated here, resulting in price being pushed up. So that is one argument. Actually, there is on a sort of micro level similar sort of price action or behavior in the very short term as compared with getting out of the bear market bottom of December 18. Moving on, to back to sentiment, if I may. It could be argued, reasonably speaking, that this 9-week downtrend that we've had is effectively a slow burn, slow bleed, full capitulation. From all the way back the end of March 2022 down to last week, the 23rd of May. We've had 9 weekly candles in a row. We've not had that in the past. Is it a sign that sellers have fully exhausted? Well, you can see here we've had huge buying pressure. The bulls really did step in on these large wicks here. And obviously it wasn't 2 weeks, it was 9 weeks. So there is an argument to say that actually the sellers have effectively exhausted themselves, and obviously with increasing buying pressure, we've effectively allowed the bulls to take control. You referenced my previous videos, but I really did highlight the fact that there was quite a lot of fear in the market. I previously mentioned, but anger too. There was a lot of anger. A lot of almost people resigned from Bitcoin, if you like. So it's got certain hallmarks that kind of support the argument that actually 9 weeks of a sell-off with combined volume here, potentially equal to, if not not too dissimilar to, the sort of crash, the 1-2 week crash that we had in March 2020. Actually, it might be on par. There may be an argument that actually we may be resuming an uptrend here, given the volume of sell pressure and the fact that the buyers have now stepped in, having absorbed all that sell pressure, albeit not a traditional capitulation over a short period of time. It's best part of over 2 months of sell pressure. The next thing I would probably draw your attention to is the monthly candle close that I just mentioned. The monthly closed literally, what time are we on? 23 minutes ago. We closed above the $29,000 level. So that's the monthly. I'll take it down to this chart where I previously put this chart together on stream. So here you can see, let me get rid of the Coinbase lines for ease of reference. I'll also get rid of that. Actually, I'll keep the arrows for now. But you can see here we've clearly closed the month of May above this line here of $29,035. It's an important level because actually the longer we hold this level, and we've held this level, we've held this level since January 21, a year and a half basically. The longer we hold this level, the more likely that we'll continue to rise and test the upper level of around $60,000. It's great for the bulls. It's a strong argument for the bulls that clearly buyers have stepped in at an extremely key level. 29,000 is an absolutely key level. We've talked about it in the past, and this is on a very high time frame analysis. This isn't daily or weekly. This is monthly. So this carries weight. That actually the buyers have truly stepped in, just like they did here, resulting in an uptrend, a test of the upper trend line. Excuse me. The next, and I suppose the sixth and final comment I'd like to make in favor of the idea that this might be the bear market bottom is actually the indices. Okay, so what you can see here is an extremely, I say extremely, but it's very bullish monthly close also for the S&P. We're actually, there was a lot of resistance, as you can see here in this zone, from best part of 4,100 to 4,230. We were all the way down here to 3,800 on the S&P, and we've been bought up the best part of 300 points this month. So that is a massive point for the bulls, being that this might be the bottom. You know, we're holding the 20 EMA, as you can see, well, only just, I think. Yeah, we are literally on the 20 EMA at the moment, so next month will be key. That's really important. We're back in the zone of resistance, but at the same time, you know, this signature or this amount of buying pressure is key. The next point on the Nasdaq is similar story here. We've clearly got huge market structure in this zone, and we've had huge buying pressure. It didn't get rejected at this level of 12,200. It could have rolled over, but it didn't. As I said, back with the S&P, you know, it really could have rolled over earlier. You know, we've got quite a bit of market structure in this zone too. So in essence, then, you know, that's my kind of take on what really is going for the bulls as far as this is the bear market bottom. We're seeing tweets at the minute of people saying, oh, well, if you're going to wait for $25,000 or lower, I'm sorry, but you're going to be buying in at $40,000 or $50,000. You know, the narrative is just switched as far as the sort of CT overarching position is. You know, I suppose I've run over the 5 or 6 reasons why, you know, the macro bottom might be in, and from here it's up only, no looking back. But what I'll do now is turn to you know, the other side of the coin, you know, which almost argues that this is a temporary relief rally, which we should have caution on the basis that there's more downside to come. Okay, I think the main observation must be that, going back to basics, we're still in a downtrend, a major downtrend. Clearly, a few daily candles, you know, the last week isn't enough to demonstrate a reversal. We've got layers and layers of overhead resistance. So it's great that we've closed above the $29,000 level, but above us at this point, I mean, we're at 31,700 at the moment at time of recording. We've got absolutely layers and layers of resistance above us. Weekly will show you more clearly. If I just draw a ray, you can see here, the main, I'll just zoom in a touch. The main resistance that we will have, or we will face, is in this zone. Gosh, there's so many. We've got candle closes here as well. You know, I'm not gonna bore you guys, but you can see that, you know, it just since the last 6 months or so, we've got tons of overhead resistance that, frankly, we will have to battle through if there is any sort of likelihood of an uptrend. I do think it is possible that a couple of these levels are taken out and found support on, but ultimately, you know, I do think there's a challenging time ahead. We've got huge overhead resistance, which can obviously support the idea that, you know, the bottom might not be officially in. It's too early to say. The sentiment as well, by way of a second reason, was crushed, and retail optimism was at the March 2020 lows. So I can show you here, this is a sentiment trader, credit to those guys. You can see that the sentiment read in March of 2020, the Rona dump, you know, we're pretty much at those levels now. What that tells us is that actually there's clearly a need, or market participants clearly expect or will expect a relief rally, because the general retail sentiment has been crushed. Everyone, I'll be honest with you, it seems is calling for a bear market. They're referencing the 1929 depression. It really is primed for a relief rally, and this is the sort of signature, this is a sort of indication that we often see for bear market rallies. So when retail is selling, the aim for the market makers will be to move the price up, get everyone bullish again, get people to rebuy higher, and ultimately force them to then puke their positions on a downturn, on the downtrend resumption following the bear market rally. Also, the fear and greed index. Sorry, not the fear and greed. It's my heat map that I often use. I'll just keep it on the weekly. Doesn't seem to be showing the readings of the hardcore green capitulation or the green bottoms. We've seen it here. We go back in time. We can see more of it here as well. Also here clearly in the 2018 bottom. We're pretty much chopping around in the greys and the blues. It's very much reminiscent of the 2017-18 bear market, 2018 bear market, where we're in the grey, the blue zone for a while, and I do think there's more time to come. So I don't see that flush out, that ultimate capitulation evidenced by the signatures in green. I don't think we are there yet. Okay, so that's 3 reasons so far. I also want to cover some more sort of macro points here. In essence, I think we need to accept that crypto is fully at the mercy of the stock markets. Okay, and crypto compared to stock markets, well, crypto is extremely risk on. If equities are risk on, crypto is a leveraged, sort of extreme risk on asset. We know that the Fed's positioning on interest rate hikes and liquidity suction reduction, however you want to call it, with QT apparently starting in June. That position hasn't changed. It could. I mean, clearly the bulls might argue, well, it's been priced in for months. That the recent sell-off has priced it in. That might be true. But any shocks or surprises, will shock the markets. It might be the case that this relief rally, which was much needed, might be effectively the creation of a multi-week exit liquidity process where the market may resume the downtrend. For example, in late June, July, August. I think this point would be silly to discard. I appreciate it's a sort of a fundamental as opposed to a technical point, but it's important. I think because crypto is piggybacking off the price action or behavior of the main indices, and the main indices are fully affected by or in control of, or the Fed is in control of that to an extent. So I do think in that way it would be silly to disregard that fact. The fact that actually, in short, this may be a bear market rally, and come June, July, August, when the market wants to turn the trend around, it may well prove itself to be a bear market rally. So there's always possibilities of bear market rally. Therefore, we should never ever get firm or be 100% on the position that the bottom's in, go all in. Don't worry about price. Yeah, we're going to $100,000, whatever, on Bitcoin. The sort of fifth reason I've touched on in the past, but I'll bring you right up to date, is actually the EMAs. Actually, the 2 EMAs that I want to talk about here, let's get rid of these, is the 20-week EMA and the I think it's the 89. Yeah, the 89-week EMA. I've covered these in my previous video, but basically, all I want to say is that on the approach to a cross between these 2 EMAs, we generally have a bounce. Okay, so if we go from the bottom to where we are now, we're at about 27% bounce. Okay, we're approaching a cross, or when we cross, we bounce from the lows. You can see that this occurred, back at the back end of 2017, going into 2018. I'll do the same again. You can see here from the bottom, we bounced about 27% again. Okay, very similar to it's this move here from $3,500 all the way to $4,500, and that was literally on the approach to the cross. And going further back in time, a little bit more fiddly, but you can see here excuse me, you can see here I'll take it from there to about there, which is about a 19-20% bounce following the cross too. So yeah, it's pretty much done it before. What we're potentially seeing now, this bounce, it could go higher. I think a minimum of I think 26% is where we are. Could it go higher? Well, of course it could, but it's worth bearing in mind that when these two EMAs on the weekly cross, there is generally a rally, okay? And the sort of sixth and final reason, if I may, is actually to do with cycle timing. I'm no expert on cycle timing, but it's worth mentioning that I think there's evidence in the charts to suggest that we're a few months early on as against historical price patterns and time patterns. So if I was to I think 455 days is about a year and a half. So if I was to take from bottom, I say that's a bottom, it's just evidenced by the volume, okay? So the volume is kind of like the riding position here. So from this bar here, sorry about this, this bar here, which was in September 17, all the way to the bear market bottom of December 18, 455 days. If we just do the same thing here, straight to the Corona dump, you'll see that also was 455 days. That was the bottom. And the next one, you can see from the Corona dump, 455 days. By the way, it doesn't have to be the exact days. Clearly, it's just a guide. It just so happens to be in the region. So you can see here, I've put it at 455 days here because actually we did have some bottom formation here, only then to rally and make a higher high. So that is why I'm including that one. And if I was to do 455 days from this point, you get best part of September 2022. Alrighty. In my mind, that's pretty much where I'm expecting it, because I may as well cover my position. Listen, I'm going to summarize. There's arguments on both sides. It really is a coin flip, but I've got to be honest. 2.5, 3 cycles in Bitcoin now. Bear markets take time. This analysis in my mind suggests we should just stay patient and stick with the plan. Okay, bear markets take time. Bottoms take time to form. There's usually an accumulation period. This might be the start of it. We don't know. It's too early to say. I'm gonna stick with my original position. Okay. Basically, that we'll probably test the upper trend line. I mean, this was a scribble on the previous videos or whatever, but I do think it's quite likely that we will test the upper trend line to around the 35. 37 mark. We may even overshoot to 40 as a fake out to the upside, but ultimately I think we stay within this falling wedge. We might fall out of it, as I've indicated here. We might not even go this low. By the way, it's one for after the summer. I do think this is a much needed rally. Okay, we've got 9 weekly candles to the downside. And yeah, the sentiment's crushed. It's primed for a rally for the summer, and I think we do get a rally in the summer. It might happen soon. It's taking us into back end of June, early July. But ultimately, I do think we touch the regions of 35 to 40,000, well, 35 to 37,000, maybe even overshoot to 39 to 40,000. But ultimately, long story short, the structure of a downtrend, a macro downtrend, is to continue. That is my opinion. That's what the facts seem to suggest to me. Make your own decisions. Do what's best for yourself. This is never financial advice. It's just for information education. But I do hope you enjoyed the video. If you do enjoy the video, or you have enjoyed the video, please like and subscribe. And I'll speak to you all in the next video. Have a good morning, afternoon, evening, wherever you guys are. Cheers. Bye.